All right, let's dive in. Today, we're strapping in to figure out one of the biggest forces in all of our financial lives, the business cycle. You know, that rhythm of boom and bust that shapes, well, pretty much everything from the job market to our retirement accounts. So let's get right to it. I mean, we've all felt this, right? You have these periods where everything's looking up. Jobs are easy to find, everyone's feeling optimistic, and then boom, things start to slow down. There's a sense of anxiety in the air. It's this constant up and down that makes it all feel like this giant, unpredictable roller coaster. The big question is, why does this happen? Well, to really get to the bottom of it, we need to know what we're talking about. In the US, the official referee, if you will, is the National Bureau of Economic Research, or NBER, and they have a very specific definition. They're not just looking for a bad month or a dip in the stock market. No, they're looking for a significant decline that's spread across the entire economy and lasts for more than a few months. It's a broad, sustained shift in our economic momentum. Now, as chaotic as it feels, these cycles do have a certain pattern to them. The famous economist Joseph Schumpeter actually broke it down into 4 distinct phases. First, you've got the expansion. That's the good part, when everything's growing. That leads to a peak, or what he called a crisis, which then tips the whole thing over into a recession, where things contract. And finally, you hit rock bottom and start the recovery, which, you guessed it, leads right into the next expansion. That's the basic blueprint for the whole ride. So if we know the phases, that must mean we can predict when they're going to happen, right? Well, that is the million-dollar question. Economists have spent, and I mean literally centuries, trying to decode these patterns and find some kind of predictable rhythm in the waves. And what's so fascinating is that it's not just one single cycle. Economists have found all these different cycles of different lengths, all happening at the same time. You've got these short 3 to 5 year waves called kitchen cycles that are tied to something as simple as business inventories. Then you have bigger ones, like the Kuznets cycle, which is linked to huge infrastructure projects. And then there's the monster, the Kondratiev wave, which some people think is tied to massive technological revolutions, like the steam engine or the internet. It's like a whole orchestra of different economic rhythms all playing at once. Let's just zoom in on that shortest one for a second, the kitchen cycle. The theory behind it is actually pretty simple. Imagine you're a company and demand is strong, so you crank up production. But there's a delay, a lag in information, and by the time you realize you've made too much stuff, the market's flooded. So what do? You slam on the brakes and cut back. That simple delay in seeing what's happening and reacting to it creates this natural little wave of overshooting and then correcting every few years. Okay, so we see the patterns, we see the waves. But what's the deep down fundamental cause of all this? This, my friends, is where the great economic debate really heats up. So let's investigate the 3 main suspects that economists point to. Suspect number 1 is the idea that the economy is actually pretty stable on its own, but it keeps getting knocked around by these big, unpredictable events from the outside. You know, things like a massive technological breakthrough, a sudden war, or a global pandemic. These are the external shocks. This idea has a name. It's called real business cycle theory, and it argues that the booms and busts we see aren't a sickness. They're actually the economy's perfectly natural and efficient response to real changes. A new technology comes along and the economy booms because it's adapting to this new potential. So from this point of view, a recession isn't a failure. It's just the economy adjusting to a setback. But, and this is a big but, not everyone buys this theory. Not by a long shot. As the famous economist Greg Mankiw put it, it's just not that plausible. It's really hard to explain recessions by saying we had technological regress, right? Like we suddenly forgot how to build cars or use computers. For a lot of people, blaming everything on outside forces just doesn't quite add up. And that brings us to suspect number 2. What if the instability isn't coming from outside at all? What if it's coming from inside us? This theory says the real culprit is human psychology, our emotions, our biases, our tendency to swing from wild optimism to deep pessimism as a crowd. This is the classic Keynesian idea. It all comes down to something called aggregate demand, which is just a fancy way of saying the total amount of spending in the economy. When we all feel good about the future, we spend more, we invest, we hire, and that creates a boom. But when fear takes over, we pull back, we save our money, we wait and see, and that very act of caution creates the bust we were afraid of. It's a self-fulfilling prophecy, driven by what Keynes brilliantly called our animal spirits. Okay, on to our third and final suspect. This one argues it's not about technology. It's not even about our feelings.
It's about the very plumbing of our financial system. Specifically, it points the finger squarely at the cycle of credit and debt.
And the mastermind behind this theory is an economist named Hyman Minsky. He completely rejected the old idea that economies always try to find a nice, stable balance. No, Minsky believed that the system itself is designed to become unstable over time.
This all boils down to Minsky's most famous and kind of mind-bending idea: stability is destabilizing. So what on earth does that mean? It means that when things are good for a long time, when the economy is stable and growing, we all get complacent. Borrowers and lenders both start to forget about risk. We take on more and more debt, building this fragile house of cards that's just waiting for a gust of wind to knock it all down. And Minsky saw this happening in 3 stages. At first, things are safe. We're in what he called hedge finance. Your income easily covers everything you owe, principal and interest. Super safe. But as the good times roll, we drift into speculative finance. Now, your income only covers the interest payments. You have to keep borrowing new money just to pay off the old debt. And finally, you get to the Ponzi stage. Here, you can't even cover the interest. Your only hope is that the value of whatever you bought keeps going up forever. You can probably see where this is headed. When prices stop rising, the whole thing collapses.
So we've got our suspects: external shocks, our own psychology, or the financial system itself. Which leads to the next big question. Can we do anything about it? Can we actually control this roller coaster? Or are we just stuck on the ride?
Well, policymakers sure do try to tame the beast. And their main target, more often than not, is you and me, the consumer. Why? Just look at this number. In most developed economies, consumer spending makes up a whopping 70% of the entire economy. If you can get us to spend more or less, you can absolutely steer the ship.
And the main tool in their toolbox is the interest rate, which is controlled by central banks like the Federal Reserve. It's actually a pretty simple lever. When they want to speed things up, they lower interest rates. That makes it cheaper for us to get mortgages and car loans, and for businesses to invest and hire. But when they want to cool things down, they raise rates. Borrowing gets more expensive, so we all tend to cut back on spending.
And believe me, this isn't just theory. It has a real, measurable kick. Research from the Fed shows that for every 1% they cut interest rates, it typically boosts economic growth by more than half a percentage point within a year. It is a direct lever on the economic machine. But this brings us all the way back to Hinsky's paradox. If the government and the central bank succeed, if they manage to smooth out the ride and create a long, beautiful period of stability, are they just making us all more complacent? Are they just setting the stage for an even bigger, more dangerous crisis down the road? It leaves us with this one last fascinating question. Can this roller coaster ever really be stopped for good? Or is it just a permanent part of the economic landscape we have to learn to ride?